and really it provides a good background to all of you in terms of how we feel that you can better arrange your finances and get the best from your monies. We try to make these sessions relatively informal. Whilst I would ask you to defer any questions until the end, there will be a chat box for anyone who does want to ask any questions. Please feel free to write into the chat box, or indeed ask any questions at the end, or you can obviously email myself. And I am also joined by two of my colleagues, David Looney and Keenan Cunningham. So as I say, we'll be attending to any queries that come in during the time. So we're coming close to 1 o'clock. I'll get started, and by way of, I suppose, giving you a broad overview of what to expect from this webinar, I'm going to be running through a few areas of personal finance that I feel will assist all of you in terms of how you can get the most out of your finances and how you can best position yourself in this financial roadmap. Now, when I talk to clients, and we've dealt with clients, hundreds of clients over the last 18 months, mostly people who have been working from home and have had a bit more time to kind of look into their own personal finances. There's some very simple things that I think we can all do that will benefit us financially. And as I say, I'll be going through that with you over the course of the next 25 minutes or so. Just by way of introduction, for those of you that haven't been on any of these sessions, Alpha Wealth was started about 8 years ago. There's currently 7 of us in the company, and I'd like you to see us as a fairly dynamic financial services provider. We provide advice in 3 main strands. They tend to get segmented into things like pension and retirement advice, savings and investments, and insurances. And it's not the most interesting subject maybe on a Friday lunchtime, but I suppose these are areas that affect all of us. And what I want to say to you is that it's not massively complex. It's just about doing the simple things and doing them in the right way possible. And I'm going to leave you some, I suppose, takeaways today that will help you and will financially benefit you. I have no doubt about that at all. You can see myself pictured here. I'm on the left-hand side. Back in days last year, this was with Dermot Bannon. We did a session there in Photo Resort just before COVID. And as I say, you know, myself and David are available to do financial consultations, and we are offering a 30-minute complimentary financial review for anyone who's on this call. Please feel free, as I say, to get in touch with us. So just to kick off, the main thing I'd like to kind of get across today is that you need to control your costs. Myself and David spend a lot of time with clients talking to them about what you spend your money on and how you can best reduce the costs that you bear. Now, without, I suppose, sounding too simplistic, the first thing that we generally tend to focus on are any debts that somebody has. A lot of you may have a mortgage, and that's the piece that I'm going to spend a little bit of time on talking about in a moment. Anyone who has a credit card, the most expensive form of debt, it would be the area that I would most focus on in terms of the most costly interest that you can bear, and then any other loans that you may have. Now, I don't want to sound holier than thou and suggest that nobody should have any debt of any description. It's just the best way of dealing with that and how you go about getting yourself into a kind of a black positive position. Now, in respect of the other areas, we can assist clients in terms of reviewing their mortgage protection, health insurance, car, and other insurances. And interestingly, one of the big things that we speak about to our clients is how can you organize yourself without going to too much hassle. We asked clients recently, you know, why did they not move their mortgage even though there was a massive cost saving? And a lot of them said it was because they felt that it was just too painstaking. There was too much hassle when they took out their mortgage, and that they just couldn't put themselves the issue of going through it again. Now, the thing I would remind you of is that moving your mortgage is by no means anywhere near as painful as taking out the mortgage in the first place. You already have the money borrowed from the bank. It's only a case of just moving that to another institution purely to get a lower rate. So one thing I should have said earlier is that we are running a poll this afternoon. I can see some of you have already applied. It's just really a way of getting some interaction from people, as I say. So please feel free to please voice your kind of preference in terms of the voting. So I'd like to get into the crux of this by giving you a sense of how we help people. And I want to start with an example. So we recently came across clients who had a 30-year mortgage. They were in their 30s and they were paying 2.95% of an interest cost, which was costing them about 1,256 euros a month. And we worked out the cost of credit for them was about 152,000 over the course of the mortgage term. With one phone conversation to their own bank, we got them to reduce the mortgage interest rate down to 2.25%, which reduced their payments to 1,139 a month and shaved the cost of credit by about 42,000 euros. Really significant on the back of one phone call. Now, in relation to mortgages, and a lot of you may have mortgages, some of you may be lucky enough to have a tracker mortgage, and if so, you hold on to that with dear life. But for those of you that have a fixed mortgage or a variable mortgage, my one piece of advice today to you is you shouldn't be paying more than 2.5, and if anything, more like 2.25% annual interest on your mortgage. So the one piece of information I would suggest that you might come back to us with is what is the rate that you're paying? And if it's north of 2.5, you should go about doing something about that. Now, if you fixed, there will be a cost of breaking the fixed rate. And depending on how long you've been fixed for and the time that you have left for that fixed rate to expire, you will find that there's going to more than likely be a breakage cost. But that could be as little as zero, and it could only be a couple of €100. And until you know what that is, it's very difficult for you to know whether or not there's any benefit in you getting a lower rate, either with your own bank or with a new institution. So the one other thing I'd ask people to do today is if you're on a fixed rate, pay more than 2.5%, contact your bank and find out what the cost of breaking the fixed rate is. And once you do that, get in touch with David or myself and we'll assist you. We won't charge you. We don't charge for advice in terms of mortgage reviews. And we do not sell mortgages. So we provide an independent service to help clients like yourself. But it is the one big way that we can suggest strongly to you that you can save money. The next area in terms of, I suppose, moving your mortgage, and this is if your bank do not have a favorable rate of mortgage or won't allow you to reduce the rate. It's really easy now to move. The introduction of Avant last year really opened up the market. They currently offer mortgages from 1.95%. And if you don't know already, you should be, I suppose, aware of whether or not you can actually get this mortgage with them. ICS just launched a really attractive rate for first-time buyers. And again, the rates are coming in around 1.95 to 2.25%. So please don't let kind of, I suppose, lethargy or this perceived fear of hassle get in the way of you getting your mortgage interest rate down and saving a bucket load of money. On top of that, for these particular clients that we save money on, we reduce the cost of their mortgage protection. So for anyone that has a mortgage, they would have been forced to take out mortgage protection. It's a really easy way that we can enable you at any stage. It doesn't have to be on the renewal, that you can look at replacing the cost of your mortgage protection with a lower policy like for like. And there's not one client that I've met in the last 18 months that we haven't been able to help. These particular clients were paying 35 euros a month for mortgage protection. We reduced the cost down on a like-for-like basis to 27.65, saving them a further 3,000 euros over the term of their mortgage with very little hassle. We operate a very effective system on DocuSign. All forms are emailed to individuals, and it takes literally 5 to 10 minutes to get the balls in motion. Okay. So as part of financial planning, and really the way I'd like you to see us is helping you along the financial roadmap, whatever age or term in your life cycle that you are, whether you're in your 30s, 40s, 50s or beyond. And all I would say to you is that it's really important that you identify what your goals are. Is it that you want to have a really nice holiday next year? Or do you want to get onto the property ladder? Or is it that you're looking to try and get your kids through third level education or to plan for your retirement? And what we do is we help our clients map out these goals and help them achieve it in the simplest and most cost-effective way possible. And typically we put in place for them short, medium and long-term goals. And we help our clients achieve that through some of the areas that I've kind of touched upon earlier. And it's about just doing very simple things, okay? I'm going to talk about pensions. Now, pensions became a little bit of a dirty word there for a while because people were a little bit unsure about the terminology that was being banded out. Advisors in the past probably oversold them and charged too much for the products that were provided, or people just don't get enough information, particularly if you're part of a company pension arrangement. What I would say to you all is that it's really important to understand what the pension can do for you. So again, what I say to my clients is, do you know what the current value of your pension scheme is now? And more importantly is, do you have any idea about what it's likely to be worth when you're
And Nick,
looking to draw
the
the
poll
pension
results
down?
are on the screen there. If you can just remove the poll results.
Apologies, sorry. Thank
Yeah,
you, Keenan.
come on.
So really what I'm saying here is that if you are saving for your retirement in a pension scheme through Say Work, it's really important that you find out what options you have, how much are you paying into the pension scheme, what is the tax relief that you're receiving, and how can you best manage that. We can't provide pension schemes to those people who have a pension scheme through their employer, but we can certainly give you some guidance and advice without any hassle. What I say to everyone is, just let me know what the value of your pension is, how much is being contributed, and when are you looking to draw this down? Is it at 60? Is it at 65? Have you ever even considered that? And let us help you map out over the term that what the pension scheme can achieve. Are you invested in the correct fund, for example? Many of you may not know where even your pension fund is invested. A lot of people would have changed jobs over the last number of years or may have an old pension scheme. I've come across a lot of people of late who worked in companies where they have an idea that there's some pension scheme somewhere, but not quite sure what. And we can help you very easily without going to any hassle whatsoever, get details on that and present it to you. A lot of you, when you left the company, would have received a form called the Leaving Service Options form. That's the document that we would look to get at on your behalf without any cost or obligation. And then we can tell you what the best thing to do is with that pension scheme. Is it to transfer it into your current arrangement? Is it to keep it separate and look to draw it down sooner than when you retire? And how you can best get the most money from that. With regards to funding pensions, a lot of people are not aware, but if you're working for a company, and let's say you're on an income of about 50,000 a year, and you're in your 30s, you can contribute 20% of your earnings, your salary, into a pension scheme. So that's 10,000 euros a year on top of what your employer puts in. And the benefit of someone putting in, say, 10,000 euros is that the government will give you a 40% rebate, typically straight away. So that will save you 4,000 euros in tax, where you get 10,000 contribution and it only costs you 6,000. It has to be something to consider. Pensions are totally underutilized in Ireland, and I would strongly recommend that you would look at this, especially if you are sitting in some cash in the bank that's earning 0% for you. And the important thing to note is that you can do a lump sum payment, you can fund it monthly, you can go forward in terms of future payments, but you can also go back. So anyone who hasn't fully funded for last year, for example, can go back and make a top up payment and get full tax relief immediately for their contribution. It's a really great vehicle for people. And if anyone is on this call who owns a business or is self-employed, they've got even greater scope to put money into a pension scheme. And it's a great extraction vehicle to get money out of a company, but also to reduce the tax that you pay. Because the biggest problem for most of us is that we pay too much in tax. And our role as financial advisors is to help you reduce the tax that you pay. Did you know there's an addition or an alternative to pensions over a 4-year period that would allow you to get the same amount of tax relief, this 40% that we refer to? So again, I take the example of someone who's earning 50,000 euros a year. And let's say that they are maximizing their pension scheme or don't have the facility of doing a pension. They can invest a figure that they may have in the bank, a minimum of which is 5,000 euros. I'm going to give an example of 10 for ease of illustration. where if they're prepared to invest that money for 4 years, they will get 40% back from the Irish government within 6 months. So they're going to get an immediate rebate of tax that they pay this year from the Irish government for a 4-year period. So if you do the simple math on that, that's a 40% return over 4 years, which equates to 10% per annum, and it's given upfront. On top of that, you're going to get back your money plus a return on investment from the qualifying company that you invest with, which you would expect to be about 12,000 all told. The scheme is known as the EIIS scheme, or the Employment Investment Incentive Scheme. And for those of you that are not familiar with it, I would suggest that at the very least, you get some information and make an informed decision as to whether or not this scheme suits you. And bear in mind that it will be available to high rate taxpayers for the next 5 to 10 years. Pascal Donoghue really reinvented this scheme back in 2019 in the budget. And I would strongly suggest that people would be aware of the fact that there is an alternative to pensions, and it is a much shorter scheme. Like pensions, it carries risk. The key thing is to understand what the risks are and how it can best work for you. This may apply to you, it may apply to your partner or your spouse. It's something that anyone in Ireland can avail of. The only provision is you have to be a high rate taxpayer and you have to have a bit of money in the bank. If you do not have that money in the bank today, my advice to you would be work with an advisor like Alpha Wealth over the next year or two, build up some funds, and then start to take advantage of schemes like this. Savings. A lot of people have money in savings accounts through the banks, post office, or credit union. The biggest problem for all of us is that the banks are paying us no interest. And that's why I have an issue with them. I often talk about the credit union and the post office as being very poor institutions for holding our cash. They weren't always historically. This has been a recent, I suppose, phenomenon in the last 2 or 3 years. But for those of you that, say, for example, are putting money away for your children, if you are putting money into the credit union for, say, a period of 10 years, you're going to find that the interest that is earned won't anywhere keep near with inflation. So you're going to lose money. The same with the post office. I was looking at the post office savings rates before I got on this call. If you were to put money into the post office for 3 years, they'll pay you 1%, not over 3 years per annum, but 1% in total over that period. These institutions have just become vaults to hold your money. And there has to be other options that are more attractive. And there are, and I'd like to talk to you briefly about one of them that we extensively talk to our clients about. And I say this to you as a parent. I have children. I am looking to save for their long-term, education, as well as people who are saving for a property or indeed for the rainy day. We set up the Savings and Investment Club about 6 months ago. It's something that is available to all people on the call. The minimum contribution is €100 a month, and you can put a lump sum in addition to that if you wish, or you can just invest a lump sum if you prefer. Now, the benefits of the Savings and Investment Club are really simple to set up. It takes 2 minutes, and again, we work over emails and on DocuSign with our clients. We recommend a period of 5 years plus. But these accounts are available without any penalty at any time. So it's really important to know that you have flexibility. And if your circumstances change, even after 6 months or a year, you can access the money without any penalties. And also you get a lot of information from us. We provide an updated monthly update to you. You have online access to the account, and we work with you directly with the provider. In this case, Zurich is a company that we would strongly recommend for this particular plan. And as I say, what I really like about it is that it's flexible, it's available to put money away for your children, for yourselves, for your grandkids, and it serves much better than the banks. Just to give you a very quick example, one of the accounts that we recommend to our clients is a fund called Prisma 4. Without getting into too much detail on this call, it is a really well-managed fund that looks to achieve 5 to 10% per annum, and the returns that this fund has performed over the last number of years has been phenomenal. And this has been in periods where we've suffered bad news through Brexit. We've obviously had the global pandemic over the last 18 months, and yet this fund has continually performed. You can see here, hopefully on this graph, the performance to August last month on this fund. It has returned 11% since the start of the year. It has made 20% over the last 12 months. But more importantly for me, and I like people saving over a medium to longer term, it has annualized between 8 and 9% per year over the last 3 to 5 years. That's the types of returns that we're looking for our clients. And if anything, we undersell this and say to people, well, look, if you set up this account for yourselves or for your children, we'd like you to think about 5% a year as a return. And as you can see here, that it has easily outperformed that. It doesn't always mean that this fund will be positive, but the key thing is to understand that if you put money into accounts like these, especially on a monthly basis, which reduces your risk over time, it is highly likely. And the key thing to note is that you can pick a fund that suits you. If you want something that's a little bit more conservative, there is a fund available. As you can see on the chart here, as the numbers go down, the returns go down, but so does the risk. Now, for me, anyone who has children with at least 5 years until such a time that you're looking to use the money for them, I would strongly recommend the fund Prisma 4. And if you'd like more information, please feel free to get on to myself and David. We talk extensively to adults who have children about the cost of third level education. It's now become, I suppose, an issue for parents helping their kids get onto the property ladder. And the key thing to note is that the sooner you start, the less painful it is. There is no sense, in my opinion, in trying to give your kids a lump sum at a certain age. It's much better to start at small increments and do it over a longer period. As I say, it's very easy for me to sit here and tell people that they should be saving for their kids. But the important thing to note is that we'll help you do that. We'll save you the money on your insurances, whether it be your car, house, life insurance, mortgage protection, and help you get the money together to put into these plans. I assure you that we'll do that without any pain or hassle to you. Couple of last takeaways now. For anyone that was working from home last year, and you may well still be at home now, did you claim 10% of the cost of working from home? On average, individuals claim back about 135 a year on the cost of their broadband and heating. It's really simple to do. We can assist you with this, but if you haven't done it, you've left money behind you. And one of the things that I feel really strongly about is that you shouldn't pay too much in tax and you shouldn't overspend. And hopefully I've given you a sense of how we can help you reduce the cost of your mortgage, reduce the cost of your insurances, get more from your savings, make sure that your pension's working for you. And more importantly is that you know what direction you're going in and how you can best utilize it. You don't have to have a lot of money to talk to us. People sometimes have the notion that they have to have money. If anything, I prefer to talk to clients who want our help and need our help, just to try and help them. And a lot of times it's just a fine tweak or a little bit of fine tuning, helping them save money on costs. I came across a client last week who was paying about €100 a month for a life insurance policy that they didn't need. And we spoke about, the fact that they had death in service through their employment, which they didn't have at the time they took out the policy, and that they had taken this policy out primarily for their children that were now grown up. And they agreed that it made much more sense for them to use that money and put it into a savings plan instead. And these are just examples of ways in which we can assist people. We give a little bit more tax advice to our clients. Again, we don't charge for that, but I'd like to suggest to you that it's really important. And there's some really good tax calculators out there. If anyone would like, I can send you on the link, the Deloitte tax calculator. It's a really easy way to see, are you overpaying tax? And it's really useful just to compare that to your payslip. And again, myself and David can assist you in terms of how you can adjust that and get that organized, dealing through the tax office. The final thing is our incomes are really important. If you are, let's say, 40 years of age, and if you are earning 50,000 a year, you're going to earn circa 1 million euros over the next 20 years. And it's really important that you make sure that that's protected. So again, something that David and myself can talk to you about is looking at whether you have benefits through your employment. And if so, that's fine. You don't need anything else. But if you don't, and if you're relying on your income, how can you put something in place at a relatively low cost that's tax effective, that will help you ensure that if you are out of work for a period of time, that your income will still be paid to you. Just want to throw up a quick summary there on some of the areas that I've touched upon. If there is anything that you want to talk to us about, please don't hesitate to reach out. We've had a lot of people who have come on this call who have kind of, I suppose, come back to us maybe 6 months or a year down the road. And all I'd say is just give us a try. You know, we're not going to, you know, obligate you to doing anything. We just want to help you in terms of how you can best navigate yourself. And the first thing that we always do for a client is give them a financial snapshot. So by giving us authorization to get details on your plans, you actually don't have to do anything at all. And David and myself will present you with a quick financial summary of where you are and then help you navigate that. I'd like to finish off by saying thank you for your time. I'm conscious some of you are listening to this on playback.